All right, we are live. Welcome, everyone. My name is Bronson Hill from Bronson Equity. If I haven't met you, it's a pleasure to meet you virtually. And we're really excited to be here to host this event to talk about the secrets of multifamily investing operators. What separates a good operator from a bad operator? What's happening right now in the world of multifamily with high inflation? What's going to happen to asset prices? All of these questions we're going to go over. So we're really excited to be able to have each of you here, and we're going to have some time for Q&A at the end. So I'm going to do a quick intro. I believe one of our speakers, Reed Goossens, is going to be joining us. He is just having a little technical difficulty, so we'll get that working for him. But I wanted to give a quick intro to each of our panelists, and then we're going to jump in. We are going to have some time for Q&A at the end as well. So first of all, we have Mark Kenney from Think Multifamily. Welcome, Mark. We have Kyle Mitchell.
Bronson.
Hey, welcome. And we're saying we love that blue microphone. That's a great color there. So Kyle, welcome from Vertical Street Ventures.
How's it going? Thanks for having me.
Absolutely. And we will have Reed Goossens join in a minute. I'm going to try to resend him the link in a second here once we kind of get started. So he will join us here in a second, and he is with Wildhorn Capital. So we'll go ahead and jump in here, and then I'll try to get Reed set up here. But let's just start about 2022. Obviously, high inflation. It's not transitory. The Fed has fessed up that it is not transitory. We do events like this also on inflation. So we had an event last month. We'll have another one next month about inflation and how that's related to investing in multifamily. But let's talk about where multifamily is and kind of where you see it heading. So why don't we just start with Mark? Can you give us kind of an overview of kind of what you see happening right now in the market and kind of where we are and where you see us headed?
Yeah, I think we saw personally a pretty big shift towards the end of last year. We did, a number of deals. We did 24 deals. And I'd say towards, November, December, and then now into this year, even people in our group would be like, the market seems different, which it is, in my opinion. I think 2022 is going to be pretty similar. And I would just preface this all by one world event can change everything we're saying. So even the experts that are so-called experts that make a living off making suggestions, predictions, or might say are wrong more times than they're right. But I do believe 2022 is going to be similar to the end of 2021. Where we saw a very competitive market. We've seen a lot of 1031 funds coming in on deals last year, and we get called on pretty much a daily basis for people with 1031 funds to invest. More money coming to multifamily than I've ever seen. And I think the deals have changed a little bit as far as what sellers expect. So before we would get early access agreements on a pretty regular basis, and we still get them sometimes, which just means we can get into a property and look at it ahead of time before we go under contract to kind of see, hey, does everything look okay before we give any money? And now we're seeing probably 80-90% of the deals we're doing right now. We have a lot under contract already this year. We're having to put hard money down basically day one, which means when we sign the contract, typically 3 days after signing, we have to wire in earnest money. Let's say it's a total of $500,000 earnest money, and a portion of that, maybe $200,000, will become hard, which means if we walk away from the deal, we lose $200,000. And we're seeing people even ask for this on, deals that are old. We just had a larger deal, $60 million deal, pretty hot market. And the broker said, well, I think someone's going to put between $4 and $5 million hard day one on the deal. And I was like, well, we're not. So, we'll bow out if that's the case. Right. But, and I think we saw a lot of deals, and we still do a lot of deals off market. But I do think that more deals are going to be listed this year more than last year because people are seeing that they're able to drive up pricing quite a bit higher than what brokers expect. So a lot of the sellers expect brokers to list the properties where before, this is my opinion, I'm seeing a little bit right now too, before where they might have been more apt to go off market on a deal. Yeah. So those are some kind of current thoughts, I would guess.
Yeah, it is kind of crazy with the hard money stuff. That's happened for the last couple of years, but now, 4 or 5 million hard day one, that's crazy. But, and then of course, as an operator, you're thinking, man, if you lose that, like it's coming out of your pocket. So that's something that is, I don't really have that much kind of money sitting around. So I know some of you guys probably do, but.
Well, I've done over 90 deals, and the first time I put hard money down was in November of last year. So
wow.
It's, yes.
Okay. So it's
now we do it on every deal pretty much we offer on.
Yeah. Yeah, that's very interesting. That's just changed. Kyle, what do you see? What are some other things that you're seeing currently in 2022 as far as where we are and where we're headed?
Yeah, so we mainly invest in the Arizona market. So when I talk about that, I'll specifically talk about Arizona because that's where our expertise is. Out here, hard money is something that is mandatory. It's something that has been for the last couple of years, but it's becoming more and more aggressive. We're typically in that $25 to $30 million purchase price space right now, and we're seeing anywhere from $1 million to $2 million hard day one, and then doubling that amount after a very short due diligence. So you're all in 2 to 4 million pretty quickly. And so it's pretty aggressive out here. So what I am seeing is newer buyers are having a lot of difficulty getting started in this market, and really any market, because hard money day one when you're first getting started is extremely intimidating. And I probably wouldn't suggest it to newer investors. So that's number one. And then kind of like Mark said, not a lot of off-market deals. Doesn't really make sense to sell off-market unless you have a very specific reason, which I can't really think of one. The market's really dictating the price right now, and there's deals going $3, $4, $5 million over whisper, if not more. So I do see that. And then the other thing I'm seeing is kind of two different sides of the fence. One, with people who have longer term debt, fixed rate debt, that say they'll sell, but they need an up leg, right? They need that to find that next deal. And that next deal is going to be very difficult to find. So more people holding on that side. And then on the other side, if you have bridge debt, you're probably in a spot right now where you're trying to execute your business plan a little bit faster so you can possibly sell sooner than your original planned exit because of what's coming, which is what we'll talk about in a little bit, I think some rise in interest rates. So very interesting what's going to happen over the next 12 months. But as far as Phoenix and Tucson is concerned, very hot market. I don't see purchasing slowing down, sales slowing down out here. There's so much capital that needs to be put to work. So I see the volume of sales out here to continue to thrive.
I think across the country, actually, I do. I mean, to your point, you're out in that market, but we're in Texas and Southeast, and I think this will probably be peak transaction year. And I also think cap rates are going to probably stay relatively about the same, with the caveat that a world event can change that.
Yeah, it's interesting. We're all kind of operating a little bit just with the information that we have. We can't, we don't know what's going to happen. We obviously can see things coming. They're talking about tightening rates. They've been talking about that for years and how that will affect asset prices. And obviously, like you shared a couple things, both of you guys, just that things are pretty hot right now. And part of it is, I like to point this out, is we're kind of in a place where at least from a monetary standpoint, we really have never seen. There's so much new money in the system that's got to go somewhere. There's no mechanism to put the money back. The Fed can't put the money back somewhere. So we're seeing just unbridled inflation everywhere. So let's just talk about that for a minute from kind of a broader perspective. How do each of you see, or maybe we can start with Mark, how do you foresee, do you think rates, they actually will be able to raise rates, or will they start and then they won't be able to? And then how do you think that will affect asset prices and performance going forward in multifamily?
Well, we've seen, a hike already a little bit, and we have seen essentially zero impact on the bridge debt until a couple of days ago, actually. So very, recent, where some of the bridge lenders are, because of kind of the interest kind of going on, that they are actually ticking up for the first time in quite a while on the bridge side. Fannie and Freddie already made their jump up already. Rates, they were planning on doing multiple hikes this year. They still may do that. I personally think, if they said they're going to do in March, I think it's a little silly, frankly, with everything going on, but, they don't necessarily make decisions based on common sense. So with all the stuff going on, it's going to be pretty interesting to see if they follow through with their plan. Even if rates do go up, which we've already seen an uptick there, I do think a lot of investors are just going to have to accept lower yields. Reality is, where else are you going? You're going to go in the bank for basically nothing, losing money on it. You go to the stock market, which is, up 800 points, down 100, 800 points the next day. No logic there, in my personal opinion. A lot of the deals are getting done through Bridge right now. We've been doing Bridge for a long time, but last year was the first time a lot of people started doing that. And cash flow, typically in our bridge business plan, isn't as important. That's not, they look at it based on stabilized values. So I just do think that investors are going to have to accept a little bit lower yields than they have in the past. But I don't see it slowing down necessarily the actual volume of data, of transaction being done, and it may have a slight impact, but I think it'll be short lived.
Yeah, thank you. So we have Reed Goossens. Welcome, Reed. We gave you your intro. We've already talked all sorts of good things about you. I know there was some technical issues, but
my apologies.
Good to see you. How are you today?
Yeah, it's love it when technology gives you that sort of.
Oh yeah, sorry. Yeah, no, that's sorry about.
Sorry, lads. Sorry, everyone who's joined, but great to be here.
It's great to have you. So Reed, we'll just have you, if you're ready, if you don't mind jumping in the hot seat here.
Let's do it.
We're just kind of given, what do we see for 2022? What is kind of continuing on with multifamily? What's changed? What are some things that you're looking at moving forward here this year?
Look, I think the big thing is we're all looking at the review mirror where we've come from and seeing how low, like all of us on this panel have probably been investing for at least 7 or 8 years when used to pick up things for $80,000, $60,000 a door. I know, Kyle, you're out in Phoenix and I see that market out there. It's like, I looked 12 months ago and you could probably still pick it up for $80,000 or $90,000 a door. Now things are at 150, 170, 200. So for me, I think the biggest thing is understanding, do I believe in that future growth? And can I get to an exit price that feels good? So looking at at different types of classes of assets, meaning vintage is the first one I tend to look at. So if you're looking at a 70s vintage, you're buying it at 150 a door. Do you feel strong that you can sell it at 200 a door or 250 a door in 5 years' time to sort of replicate the same sort of returns, a mid-teen IRR to your investors? Or do you try and buy something with slightly a little bit more value per door, but it's slightly newer and you don't have that obsolescence, if that makes sense. So I think in general, it's backing into, do you believe in, firstly, your business plan? Can you continue to grow rents at a nice clip? I'm sure all of us on this panel have been investing so where you can buy, in-place rents are $1,000 and you're trying to push them to $1,300, $1,400 over the next 4 to 5 years. Do you still believe in that type of rental growth, or are you trying to push it to $1,800, $1,900 and you're trying to sort of get a little bit too far out over your skis? So a combination of things that I'm looking at. I'm looking, one, where we come from, 2, the type of vintage and what I can sort of resell it for in 4 or 5 years' time. And then 3, backing into my business plan to say, okay, do I still continue to believe that my rents are still quote unquote affordable given where we've come from? And, is a $1,500 rent in 5 years' time really something that I could live with in a certain area, in a certain demographic, in a certain location?
Yeah, no, it is amazing right now, the rent growth that's happening. And when you look at valuations and kind of how that's affecting valuations, I mean, we had one that in Jacksonville recently that I think it was like $890 a unit. And after renovations, $10K per unit, we renovated 10 of them. We're getting like $1,320 a unit or something now. Yeah, 13 to it's crazy. So we're seeing like a 50% growth on turn units, and some of these markets are growing 20-30% a year. And we've just never, I mean, I don't know, maybe there's been times, Mark, over the years where that's happened, but kind of a crazy time. We're going to continue on with Kyle. So Kyle, tell us a little bit about, what do you see? We were kind of getting into some of the specifics, and I actually don't remember the specific question, but I know you probably have
interest
rates. Yeah. How is interest rates going to affect everything?
Yeah. So look, even if interest rates go up 100 basis points, we're still at historically low interest rates. Number one, I think we've been spoiled a little bit over the last couple of years at how low they really are. But I don't see it. I agree with Mark. I think that they'll pop up a bit, but I think they'll stabilize towards the end of the year. Can they get out of hand and go up 150 basis points, 200 basis points? Maybe. But I think that I just can't really see that, to be honest with you, right? I just don't know that that's going to happen, but we'll see what the Fed does and kind of go from there. But I don't see the multifamily market slowing down at all. Like I said earlier, there's just too much capital in place. Where are you going to put your money, to Mark's point? And just the pure fact, at least in Arizona, of the supply and demand imbalance out here, people are going to continue to buy multifamily and believe in real estate and in hard assets. And in an inflationary environment, why wouldn't they be purchasing a hard asset? So I do think that rates will tick up. I don't know how much it'll affect the multifamily market in the long term.
We had Ken McElroy on this monthly a couple months ago, and he was sharing something like 6 million more apartments is really what is needed in the U.S. So we have an incredible demand for apartments, and of course, a lot of us I know are buying in areas where there is not rent control. It's very landlord friendly. I just was sharing with somebody earlier, I don't know if I was on this before the webinar started, but in L.A. now, city of Los Angeles, there's an eviction moratorium that's still in place that started at the time of the pandemic, March of 2020, and it's basically goes until I think it's June of 2023. I think that's actually what, so it's over 3 years. So, I mean, and there's something, actually Ken brought up this issue on the last one, that even potentially areas where we have not had rent control, there is a chance that may actually start to pick up. And we're seeing it at St. Paul, Minnesota. We're seeing it in some other kind of Northwest cities. Well, is that something you guys are hearing rumblings about, or is that something you're concerned about in these areas that have not been rent control markets that you're buying in, but that may be a concern in the future?
I think there's rumblings out there on it for sure, but let's be a little, if you want to get political or not, look at where you're buying red versus blue states. I mean, just get real about it. But inside a state, I would say that the first time we really got tested are really so-called landlord-friendly states. That's a misnomer in some cases, meaning like when they said, "Oh, Texas is so landlord-friendly," well, Dallas County wasn't. The judge there wasn't. Collin County was. So you really have to see how some of these properties reacted. Georgia is pretty landlord-friendly overall, but I can tell you some submarkets there, they weren't landlord-friendly at all, and they're still not today. So I do think it goes down to much lower than, picking a state to say that it's, landlord friendly. One judge that gets elected into a certain, district can kind of change the sentiment there. Right. And we've seen that actually, but we never were tested like that before to see how someone's going to react. But we saw it during COVID. I did personally anyways.
Right. And we know you buy in red states, but you do have a blue microphone. I just wanted to point that out.
True.
I'll follow on from what Mark said. And I know in Austin, down in Bexar County and Travis County, they were very non-landlord states. But I think you're also going to have a little bit of, as you see this, one of the things I'm looking at least when I'm buying deals in Texas, is how much my taxes are growing on my P&L every year. And something that I look at for year over year is that growth in taxes. And I am seeing murmurs and rumblings. I've been involved in 2 deals where we are self-imposing a rent restriction in order to get a reprieve from the taxes. I'm talking about a massive reprieve, like a 50% reprieve on my tax bill. When my taxes in Texas are 25 to 30% of my P&L, halving that, and still being in an area where I can push, the AMI is still growing quite steadily and back to that in place versus where I want to push things to. Well, that's a type of rent restriction. It's a way of the government giving back to landlords saying, look, we know rents are escalating like crazy. Here's what we're going to do to help you do that. Phoenix is not as bad as from a percentage on your rent roll, but when you've got states that have no or low income tax, they get it another way, and that's usually through real estate taxes. So otherwise, I'm looking at certain quote unquote rent restriction is also, can I have my cake and eat it too? Can I push rents, have a reduced tax, quote unquote be affordable, but also being self-imposed affordable. So when I do sell the deal on, I'm not encumbering the deal for the next 5-10 years, like a LIHTC deal or something like that. So definitely seeing a lot more institutional quality players in the Texas market, particularly in some place like Austin, come in with that mindset to say, how do we sort of solve the affordability, which no one can ever really solve when you're having inflation as where it's at today. So
just real quick on that too, to follow up, that's not where Reed was going, but insurance in Texas has just skyrocketed like crazy. So, and we're in 12 states. We buy some other states. There's not a blip, but I can tell you in Texas, Dallas, it's
Mark, what are
double.
those states? What are those states we're coming to those states?
Some of the Carolinas are pretty low. Arkansas, Georgia is better than Texas by far. Texas is one of the worst, in my opinion. We're paying way more on insurance. So I know it wasn't really the the question or direction, but it is something to consider as you look at different areas to buy in.
And I think too, I wanted to say one thing here is that I think we're seeing it all over, right? We're seeing costs going up. There's from insurance, it's from, rents, right? I mean, there's just, it's hard to find good staff. So costs there are going up. It's hard to find product to put in when you're doing renovations. It's hard to find different subcontractors. So as the cost of ownership goes up for multifamily owners in general, that has to, cause rents to go up as well. So my thought is over time, whatever happens to cap rates, whether they stay or they go up slightly, I think the cost of ownership is going up, which leads to higher valuations or at least stable valuations. Kyle, can you talk to us a little bit more about what you see as far as rent control? Are you concerned about that in Phoenix? Are you hearing rumblings about that in your area?
Yeah, it's not on the ballot, but there is whispers of rent control. I mean, when you're in a market that had 20 to 23% rent growth in the last, 12 to 14 months, you're going to have people bring it up. And we do have 220 people moving here a day, and a lot of those people are coming from blue states. And so the blue wave is kind of coming in. And so we are hearing grumblings about it. So it is on my radar and something to keep an eye on. Like I said, it's not on the ballot quite yet. And I agree with Mark. I think, Tucson may see it before Phoenix. And so definitely it's going to be a lot more localized first and then go from there. But it's always something to keep an eye on.
And we're seeing it as well in California, where California has a statewide of about 5%, but I got a flyer on my door a couple months ago that was like, we're trying to basically lower it to 2 to 3% per year, which is kind of crazy if you think about it. Inflation is 7.5% to 15%, depending on who you talk to. If you're capped at just not being able to, improve rents more, that's very difficult. So let's kind of shift gears here for a second. Let's get into kind of that we really marketed this as best practices in multifamily. And I know a lot of people are new, they're interested, they're curious about what that looks like. The reason we talk about this macroeconomic stuff as well is it's really important for you as an investor to pay attention to what's happening in the world, what's happening in the global economic structure. There's stuff that's happening now that's never happened in the history of the US. And it's just really important you pay attention, not just to real estate, but also the global, overall economics, as well as political and some of this other stuff as well. But let's talk a little bit about when it comes to actually operating multifamily assets, what would you say is one or two kind of best practices that you've developed over the years? Let's start with Mark on this one.
I think it's not really much different than any other business, frankly. I mean, there's the fundamentals being, organized. If you're not organized, you don't follow up and you don't track things, typically even on a daily basis, you're gonna have issues. Some of the, kind of more things we've learned as far as being in different states and trying to take a property management company from one state to the other, which we've tried a couple of times, hasn't been that successful, frankly. So having that local expertise, just because they have all the relationship with contractors, they also have, they know what the city expects and things like that. And a couple other things we've done, which we don't do anymore, is we've had certain projects where we split up duties. So we might have a property management company do parts of a unit turn, and then we'll have like a general contractor to try to so-called save money. It just ends up finger pointing, doesn't work out very well in the long run. We don't save any money. We're actually losing rent by doing that. So that's something we've done before. The one big one, and not to get too much in the accounting piece, but if you don't understand, at least some fundamentals between like, accrual-based accounting versus cash-based accounting. So if you look at a report and you see accrual-based accounting and your PM says, hey, we've collected all this money. No, they have not collected all that money. They just think they're going to collect it. So there's some major things there fundamentally. If you don't understand the financial piece of it, make sure you have somebody on the team that does, because you're talking hundreds of thousands of dollars and potentially millions of dollars of difference of value based on, just putting $30,000, $40,000, $50,000 difference on a line item, which you'll see all day long on accrual versus a cash-based accounting.
That's a great tip. Yeah, actually, how do you account it, and when do you do it, and making sure the numbers make sense. I think a lot of people just think that it's easy to go raise a bunch of money and do a deal, but it comes down to being able to keep track of everything. And I know all three of you guys are really good at this, and you really are able to get into the weeds and find out exactly what's happening, identify where expenses are, income is, and really make sure that's maximized. Reed, what about you? What say you as far as best practices that you've really pulled into your operations there?
I echo what Mark says. It's so funny when you look at the income and they're on accrual and they pay them, the property manager pays himself a bonus. And it's like, wait, you have $80,000 uncollected. This is, for those people listening out there, it's cash on income, it's accrual on expenses. All right. You got to make sure you understand the delta between them. And if they're not putting bad debt or extraordinary bad debt above the line in income, then change the books. So I completely agree with Mark there. And then having someone looking over your shoulder, I think there needs to be the property level accounting, which you're going to pay for, but you need to then pay for, if it's a fractional CFO or a part-time bookkeeper, to be looking at those books coming through to your investors. Make sure I know I've personally got caught once or twice before on when we're getting started, where it was a little bit embarrassing to show the investor the property levels books. And we learned very quickly that we have to have a layer between the property level management and our corporation level. In terms of, material, I was talking at Best Ever Conference over the weekend about material sourcing. I think that's a real way where I can continue to control my expenses. Again, to what Mark is saying, using local labor, but if you can take in-house, and control the material side of it, whether it be flooring or granite or plumbing fixtures or door hardware, then you're really just negotiating on a labor basis, and there's a lot of people who can install flooring at $1 a square foot. So helps when you go and scale across the country. And then on the marketing side, making sure that we have all our processes in place to onboard new investors in a right way in terms of technology. I know a lot of people, both Kyle and Mark on this show would be using investor portals. That's been a relatively new thing in the last probably 7 to 8 years. That I'm excited to see that space grow. How do you then report back to investors? How you make distributions a lot easier? Anything that can make the investors' experience an easier one is where I'm sort of also getting quite excited about where the industry is going and trying to keep up with best practices.
I think it's really good to point out here. So for some people, this might seem a little bit over your head. Why is it important to talk about accounting or whatnot? There was a book that I read in college, and it was from a class. It was a finance class, and it was called How to Lie with Statistics. And I don't think anybody necessarily wants to lie, but you can make the numbers say what you want them to say. And you can account for things that aren't necessarily accurate. It's not even always an intention to do it. It's just that really keeping track of money that is actually coming in, what is good debt, what's bad debt. It is really important because how that deal is represented is really important. So great operators really do that. They make sure that they really know their books well and they communicate that well. And also, as Ken McElroy says, that if you deliver bad news early, you can actually build trust. And so that's a sign that's looked for as well. As bad things are going to happen in every deal, but the communication of that is very important. So Kyle, why don't you talk to us a little bit? What are some best practices that you've incorporated into your business?
Yeah, I'll add on top of what both these guys talked about. Number one, always check your balance sheet, right? That's where you can hide a lot of money. And if you're only looking at your T12, you're in trouble. So a lot of people don't even know to check their balance sheet, and that's where a lot of that money can go. So but some of the best practices, I would say, when it comes to property management, may seem simple, but hire someone with some infrastructure, especially with the way things are right now. If you have a smaller property management company that you basically have one person running the show, what's going to happen when a manager leaves and they're fired or they quit their job and there's no backup, there's no bench for them to fill in? All of a sudden you have no staff on your site, right? And so I really like hiring property management teams, number one, who have a large portfolio in that market. So we actually use 2 different property management companies between 2 markets that are just 2 hours away because they both have strong infrastructure in that market. So they've got construction teams, marketing teams, they've got I can't remember what floating maintenance teams, floating managers, so that if there is a shortage or someone does quit, you can backfill that pretty quickly. So that's number one. And then the other thing that we just did was bring construction management in-house. And the first goal on that is really to create efficiency, not as much as cost savings when we're first getting started. We just want to make sure our team is able to work on our properties when we need them. So we typically only do about 5 or 6 units a month. We want to up that over the next 6 months to 10 to 12 units a month to execute our business plan a lot faster so that we have more flexibility sooner rather than later in our business plan with where we are in the market today. So we're bringing that in-house, and that also relieves a lot of pressure off of the property management company to do what they need to do on the day-to-day and to lease up the units, but they don't have to worry about essentially the construction piece and making sure those units are being turned. Over the long term, we want to bring down our margins and lower our costs, but at first we're focused on efficiency and making sure we can execute our business plan in a timely manner.
So I know I have a relationship with all of you guys, and all of you either have a very extensive business background or, just everything from architecture to managing golf courses to CPA work. There's a lot of not only numbers that I see with all of that, but just the ability to run a business, because running a multifamily deal is running a business, right? You're running an actual, and you're running multiple businesses, which I think is really admirable, and all of you are exceptional at that. So I just wanted to, from what I've seen and worked with some of you on specific deals. So thank you for that. Wanted to just ask you, as far as in the current environment, not only do we need to operate deals well, but also we need to be able to find new deals. And I know it's getting more and more competitive. We kind of touched on this earlier, that, putting 4 or 5 million hard day one and all kinds of crazy stuff. But what do we find that's working to find either off market or other types of deals that you're not one of 30 at the table and you're having to give away the everything and overpay to get a great deal? Mark, why don't we start with you?
I think to Kyle's point earlier, it's pretty difficult if you're new. I mean, Kyle had mentioned that. I would agree for sure. A lot of the markets we're in, we've done, a dozen plus deals with some of the, a broker, for example, in a given market. It doesn't mean we get steal of a deal right now, because no one's really getting a steal of a deal on anything. We definitely can be a little bit lower on pricing and just through reputation and things like that. But it hasn't changed. We talked about more earnest money, all those things, but the fundamentals haven't changed. Be a good buyer, be a good seller. Don't be a jerk. And don't ask people to do things that you wouldn't do. I don't ask buyers to do things I wouldn't do myself. Could we potentially, and could we convince someone to do it? Probably. But you need to be a fair, not a pushover, but fair on both sides. And if you accept an LOI in a deal and then someone else comes in with $100,000 more, you're going to kick the first guy out because you got a new LOI in. It's your decision to make, but I can tell you're going to ruin some reputation in a place for sure. So you have to look at everything from a long haul perspective, and also understand that anyone you're hooked up with from a partnership standpoint or anything like that, your reputation is going to be tied to theirs. So only do business people that you know and trust. Everybody says that, but people do business with people because they make money sometimes, and it's not necessarily the right reason to do business with somebody.
I think we should make you a T-shirt that says, "Be a good buyer, be a good seller, don't be a jerk." I think we could sell some of that.
Tammy's always like, I'm like, no, it's true, man.
It's true.
We're all. I'm too old to do stuff with people that I don't want to do business with anymore. So.
Yeah, and you've shared some stories of how people have been jerks, and you're like, we're never going to learn this guy. I remember you've shared a few of those with me, so I appreciate it.
I
have. Kyle, what about you? What are some things that you're finding that's working to find deals these days?
Yeah, I echo Mark. It's all about your reputation as a buyer, right? And so as we continue to close, we've done 13 or 14 deals now. We are now known as a closer in the market. And so I don't have to make as much of an effort to find deals as I did 2-3 years ago when I was first getting started. When I first got started, I was calling 50 brokers every 3 weeks just to drum up deal flow and to actually build a relationship. But now that I have an actual relationship and we've closed on deals, they're the ones calling us. So that's really the source of our deals, is just continuing to build on those relationships. So, and it's not just calling them to say, hey, what's, you got a deal for me? And I think that's a mistake that a lot of people make. You've got to really form relationships with people and take the time, energy, and effort. And, that list of 50 brokers, I still have it, but there's really only 10 core brokers that I now speak to, and I consider them my friends. We go play golf, we go out to dinner with the wives, we do all this stuff. And so we've been able to build very strong relationships in this market, which is why we are really market focused in Arizona, and it's benefited us.
That's great. No, I think that's building relationships over time. You've done very well with that. Reed, what about you? What are some ways you guys are effectively finding deals these days?
Yeah, I think I'm going to be echoing everyone's. It's relationships, but it's also looking at a lot of deals. Like I know when I first got started in this business, 6-7 years ago, you probably look at 50 deals, you can get 2 or 3 to really work. I think today you sort of really got to be looking at a plus 100 units. So if you're not willing to roll up the sleeves, you're not willing to set up a system within your business to underwrite a lot of deals, you're not going to see all the ones that make sense. In saying that, you also got to deals are so, we'll call them thin these days, that you have to understand the story. You have to understand what's going on down the street, what's going on across the city, what's going on in terms of trends. So when you underwrite more deals, you're going to see those trends start to emerge in your underwriting. Do a desktop study. You may not be necessarily boots on the ground, but you can do a lot of work remote. I think to both Kyle and Mark have done really, really well, is build local presence on the ground in each market that you go into. Obviously you always start with your own backyard if you can, but if you can't do that, make sure you're getting into a market where you have a bit of special sauce, whether you have a business partner there or you have family members that can sort of tell you what's happening in real time, so you can put that back into your underwriting to make sure that you're really seeing really analyzing the deal for what it's worth, not just on paper say, oh, well, what's the going in cap rate? Oh, that doesn't work, and pressing pass. So because you will be pressing pass on every single deal moving forwards.
Right.
True.
Yeah.
True.
Yeah. There's a balance between being too conservative and too aggressive, and trying to find that sweet spot is really important. So I wanted to mention too, for some, somebody may be watching this and being like, hey, I'm a passive investor, or I've never invested, but I'm interested in doing it. Or maybe you're interested in doing it yourself and finding deals. And there's been, both Mark and Kyle mentioned, it's kind of tough to do when you get started, but there are things you can do to actually borrow credibility, where you find partners that are more experienced. I've partnered with people that are more experienced when I was getting started, even still, that are more versed in finding deals and asset management. Or as Kyle mentioned, you just take massive action. You just start, calling everybody and going out. And once you start doing it, people start taking you seriously. And then once you get your first property, it's amazing the doors that can open. I wanted to shift here for a minute. We're going to take some questions here in a couple minutes. So go ahead. There is a chat section here for those that are live. There's also a little bar on there that says Q&A. So if you have any questions, just put it in the Q&A section there. We've got a few questions. Just go ahead and line those up. We'll start in a few minutes on those. But I wanted to, I feel like really a great way you can invest in yourself is through education. So this event is educational, but I also wanted to ask each of you, what is one thing that you would recommend somebody who's new, either wanting to get involved passively, or somebody who's wanting to do their own syndication or their own large multifamily deals? What would you recommend they do to get started? Let's go ahead and start with Reed on this one.
We'll turn my mic back on again. More technical issues. I think starting is obviously the first place, right? Education, doing something that is continuing to move the needle forward. I think some people get too caught up with doing the big deal first, right? I've always been a proponent of do what feels right. I remember buying my first ever property as a triplex back in 2012. That's what I could afford. That's what I felt comfortable with. Do that, because that's still moving the needle down the road. You're still going to get experience. You're still going to gain relationships. Everything that you do on a larger scale, you're going to have to do on a smaller scale first. So if you're wanting to be an operator and you really want to be an owner, go out and do some deals on your own first to prove it to yourself. If you are trying to be more of a passive investor, there's a smorgasbord of operators out there in different asset classes that you can go pick and choose from, which is the great benefits of the Jobs Act that passed in 2012. So whatever side of the coin you're around, continue to move the deal forward. And I always talk to the people who want to be active operators, because that's where I came through. If you're going to want to be an active operator, you want to get involved in deals, do something that you think you can take down. Maybe that's a quad. Maybe that's a 5-unit. Maybe that's a 10-unit property with a couple of mates. Do something that sort of fits your box and make sure that you can go and execute on it. Because once you execute on that, then those boundaries that you're pushing become bigger. You go to a 50-unit deal. Then once you do a 50-unit deal, you can do a 100-unit deal. So it all starts with, for me at least, starting with what you bite off more than what you don't bite off too much more than what you can chew, and crawl before you can walk, and walk before you can run.
It's a good word. Get in motion, and don't you don't have to do the hugest deal. A lot of times we're thinking all or nothing, and sometimes just micro steps every day, every week, calling brokers, looking at deals, joining people's investor clubs. These are all things that are not hard to do, but they're things that we need to take action toward, and that's great. Mark, what would you say? What's something someone can do to educate themselves, or to get started, or books they can read, or anything you'd recommend as far as kind of moving forward?
Yeah, you mentioned, podcasts and events, and I would say those are all great for sure, but just being around somebody doing it. Yeah. Let's say that, Bronson reads a book, How to Fight for 3 years. I'm in the ring for 3 years. I'm pretty sure I know what's going to happen if we get in a ring, right? It's a real world experience, right? So there are a lot of opportunities to maybe go on a property tour with somebody, due diligence, Maybe someone's actually needs some help going through some of the tedious things like, hey, review this contract. So find a place that there are certain things you're good at, you like, other things you don't like and you're not good at. Focus on things you like and you're good at because you're probably going to be better at them. And then try to offer that up to somebody that maybe isn't as good in that area. So if you like underwriting, Bronson, and I'm like, I hate underwriting, I never want to do that, then it's a good match. So I think, you only learn so much by reading and listening. I think you have to get out there and do it. And that's the best way to do it. And as you mentioned around passive investing, start small. If you have, several $100,000 you want to invest, try to put in the minimum someone has, maybe even try to, if it's 50,000, 75 or 100, try to put in like, if it's 75, say, can I put a 50 in? Just get in there. You're going to learn a decent amount by doing that. But reality, you don't learn a lot, in my personal opinion, as a passive investor to then become a syndicator. There's so many more things involved in it.
You shared a couple big nuggets there I just want to point out. So if someone is interested in being active, you brought up this idea, and I call it, actually Jim Rohn said this quote of make yourself valuable to valuable people. So find out what sort of value you can bring to people that are doing what you'd like to be doing. And if it's raising money, then raise money. If it's being a part and doing diligence or finding whatever aspect that is, you just make yourself valuable. And then the other side was more on a passive side. I really think having spoken with 1,200 investors one-on-one on call, is the biggest thing that's lacking is the confidence to know that this is a viable investment source and that you can do it and generally get a good return and hopefully double your money every 5 to 6 years. Now, that's not a guarantee. That's just saying it's getting the confidence that you work with a good operator and that you're really able to invest in a diversified way with different deals to be able to get a good return on your investment. So it's developing that confidence. The only way you do it is you actually do the work and then you actually start investing, which is great. Kyle, talk to us a little bit. What advice, what tips would you give as far as people starting out?
Yeah, number one, you've got to take it seriously, right? There's so many people there around that will be around the circles, go to these meetups for 5, 6, 7 years, and you still see them in the same spot. So if you're not going to do it seriously, don't do it at all. In this business, we raise capital from private investors as well. And if you're taking someone else's money and you're responsible for it, you need to be fully educated. So really dive in and get to know what you're doing. And, these guys already said it, but surround yourself with people who are already doing what you want to be doing and elevate your game. If I go hang out with Tony Robbins right now, is he going to elevate my game? 100%. If I go hang out with someone that's just getting started, not there's anything wrong with that, but you're just not going to grow as much. So if you really want to grow and get out of your comfort zone, you've got to really surround yourself with other people who are 1, 2, 5, 10 levels above you.
That's true. Yeah, getting around people there at that next step. That's kind of what Mark shared as well. So we're getting some good questions in there too. If you're live watching this, just go ahead and drop them in the question and answer section there. I'm going to start with Jeff here. Let's talk about prop tech. What are your thoughts on implementing smart apartment technology, smart locks, thermostats, things like that? Are there some things that you're seeing as far as tech that's really changing the way some of these properties are being managed? And you guys can just jump in. Whoever wants to answer that.
We're doing it right now at a few properties. I think it depends the type of asset and the location that you're buying in. Obviously, if you're buying in a Class C location where the median income's $30,000 and you're putting in smart locks and thermostats, you're not going to make your money back on that, right? So you definitely have to make sure that your property or the area can support it. But we just bought a 2000 build property. Median income is about 80,000, and so we know it can support additional bumps or other income. And so we're installing tech packages, which come with, the smart locks, smart thermostats. It even comes with leak sensors, which is fantastic. And that'll ping back to the office if there's a leak in the unit. And so we rent that at $7 a month and we charge the residents back $40 a month. And so that seems to work. But the one thing you got to be careful of there is don't add that into your rent. Make sure that's a separate line item. So you're making sure that you're getting your ROI on both your rental increases and your actual, other income, whatever you're implementing. So I do see a benefit and an additional value add for property tech like that, but it definitely depends on the asset and the location.
Great.
I would also say, just to add on that too, 100% the asset location, but also who are you renting to? So we had a property that I would say probably fell pretty low on the household income, but it was really close to a university. So, younger people renting there, they were okay paying it because they expect it, right? For the tech to be there.
Yeah, and I'll just add that we rolled out. I think you can start pretty small on a small scale. And it's not really small, but everyone wants internet. So having a managed Wi-Fi system is a good way to increase the NOI. It's a good way to capture that income rather than just give it away to Time Warner Cable or Spectrum, or if they're the same thing, or AT&T. So I think that is a good, easy step. That everyone's going to need that in the future. I will say, coming out of COVID, you're seeing a lot more tech come to the real estate space, which is really a wild, wild west when it comes to tech, in terms of virtual leasing. And I think some of the ways we're forced into doing business in the last 24 months will be around for the future. And that's really, really exciting to see the industry grow.
Yeah, that's very true. We're getting some questions here a couple of questions about cap rates. So cap rates are getting squeezed low, even sometimes 2%. Interest rates are going up. How does a deal make sense? And also, how do you underwrite with your reversion or your selling cap rate? Does somebody want to tackle that?
I can talk a little bit about it. I mean, going in cap rates is one metric and one side of the story. You really need another side of the story to finish that off, meaning what is your business plan? What's the story of the property? What's the execution? If I can buy a 1 cap, but I can take it to an 8 cap in 2 or 3 years, then I'm fine. But if I'm buying a stabilized property at a 2 cap and that's where it's at, then that's a little bit of a red flag. So there's always a separate part of that equation. And so is there enough value add is kind of what you're looking for. Cap rates are definitely compressed. It is much more difficult to get it up to the cap rate that you needed to. So to get that value add, so you've got to be careful and you've got to underwrite more deals like Reed said, but the going in cap rates is one side of the story.
I want to say something too. Some people may not be familiar with cap rates. So this has to do with how much you're paying for the property versus how much income you're getting. So when you start, you could be the income is very low on the property. He's basically saying if you're able to increase the income on the property, it raises the overall cap rate over time. Mark or Reed, do you guys have anything to add to that?
I was just going to say, the whole question about what's going in cap rate is a loaded question, because half the people don't even they're looking at the T12 and saying, I'm buying at this, I'm buying this in Dallas at 6 cap. Yeah, good luck. It doesn't exist. It doesn't, right? So, or we talked about the accrual based counting versus cash, that difference there, or T3. You really need to know and have data as far as what are properties selling for in the marketplace, what cap rate, are they selling for? And even that is a little bit, do you have their financials to do that? Or you're just using information from CoStar or Yardi or from a broker? I think once you get into a market, what the cap rates are very closely. If you're new to the market, then you need to find somebody else in the market that understands the cap rate there. But, to Kyle's point, we'll buy at 1 cap, no issue whatsoever. People are like, you buy at 1 cap? Well, Kyle just said if you bring it to an 8 cap, maybe the property, we bought properties before 0% occupied, 38% occupied. So those are ones that you're not buying on the cap rate,
Yeah, exactly.
Go ahead. I was just going to add, yes, echoing all that. I think one thing I like to do, and I don't know have any of you guys like to do, I like to graph on my model the T12, like GPR and net rental income, the expenses, then do a line of best fit, and then compare that to my pro forma. And if my pro forma was going off at a 45-degree angle, but yet the GPR of the T12 is sort of really quite flat, I've got to really understand, well, do I believe in my own, BS at that point? Because it will then back into, okay, what's the business plan here? What Kyle was saying, like, am I trying to bring rents up from, $600 to $1,200, or what Mark just said, am I taking it from a 35% occupied to 100%? That's all going to have different effects on those graphs, but I'm a really visual person. So if anyone's out there who's listening, try graphing it and seeing how it looks, and do you believe in the two different line of best fits? It's an interesting exercise, more academic, but it helps you really buy into what is this person trying to sell me.
And one word of caution, it's a great point too, for sure. But one just word of caution, when you see a T3 that's kind of going up quite a bit, you never know, right? The seller's prepping it to sell. They're telling their property management company, they're shoving people in there just to get them in there. The occupancy is going up higher than it was for the last 9 months. So just be a little leery of that. And then you also have to Reed's point, if you see that it's going up like this, what is it? Is it that loss of lease is going down? Bad debt's going down? Bad debt's one of the hardest things to overcome if you're buying a property that's in a relatively not attractive submarket. lost the lease, and they proved it out already. But bad debt is difficult in some cases to do that. And a 50% occupied building is worse than a 0% occupied building because you probably don't want, once you get it done, you don't want any of those 50% in there anymore.
Yeah.
So just be aware of that.
Very true. I want to make one comment real quick. I know for some people, again, this is a pretty high level conversation. So if there's terms or things you don't understand, make a note of that, research that. I'd rather have a conversation that's more high level and have people kind of catch up rather than have just a really basic conversation about this. So it's important, I think in general in your education, you find if you're the smartest person in the room, you need to find a new room. So that's what I do. That's what I'm doing right now. I hope that you are also finding that for yourself as well. So we're getting some good questions coming in here. We've got a few more minutes. And this is, I think, a good question to go over. This is from Babu. What states are still good to invest? I know Mark talked about red states and blue states, but let's just talk about, maybe what states or what markets do you find? I know you guys have shared the ones that you invest in, but maybe just also some of the qualities of those markets that you like.
Yeah.
Jobs.
Yeah. It's a broken record.
Follow the jobs, follow the money, follow where the growth is. I think it's got to be everyone's sentiment. So you've seen a lot of that growth in the mass migration and since COVID. But I'll also add that real estate's kind of local, and I know people in LA who are making money and people in New York are still making money. So you've got to really understand your market, but try and follow where people are moving to, because that's going to be ultimately where people are going to spend the money, and that's where you're going to see where growth opportunities are.
Yeah, just one potentially addition to that, because I agree 100%, is that there are certain things that go on in a market, even though the population growth might not be strong and job growth, where they have some incentives. So we've bought properties before where you go in, improve the property. The city actually cuts your property taxes in half, and they freeze them for 20 years. So, cut your property tax in half for 20 years, they don't go up. So there could be those softer type things you look at, and a lot of places don't offer that. And then the other one would be, yes, job, but if you can't evict and people can live there for free, it's a big issue in my mind. So understand the how COVID was the biggest test for everybody, I think, probably, of how easy or hard it was to evict. And we have enough, we've done over 90 deals, right? So I have enough data points now and be like, yeah, I'm never buying there again. We might never have that problem again, but I got sick on meatloaf when I was 16 and never had it again. So same thing, right? So it's true.
So you haven't had good meatloaf, mate.
Yeah. You live in a meatloaf state, then you don't talk to Mark. So I live in a meatloaf state. Yeah. Anybody else have anything to add to that? We've got more questions. If not, we can move on. What are the odds? This is a good question from Aman. Aman, I might, if this is the same Aman, I'll see you at Phoebe. We have a in-person meetup once a month on a Wednesday. So if anybody's ever in the LA area, the first Wednesday of the month, including tonight, we'll be there in Pasadena. So reach out to me if you're interested in that. What are the odds that rent could go down in coming years, or can we only expect exponential growth?
I can only speak to Arizona, and when I look at it, I don't have a crystal ball, but it's just simple supply and demand imbalance, right? And I just see rents going up. I don't see there's really any other way. And the other part about it is, even if you build more, we're not needing housing in Class A. We need housing in workforce housing, Class B and C, and you're not building that right now, really. And so I only see rents going up. Again, Arizona, 220 people are moving here every day, and they're already short on housing. So there's really only one way it can go.
Yeah, I would just say, in reality, if multifamily is having a bunch of issues, then the whole world's in trouble.
Yeah,
it's a fact.
Go ahead,
Reed.
I was just going to say, the only other thing is this, which is really sticky in inflationary environments, is wages. We're finally seeing some move in wage growth. If wages are going to go up, people can afford more. Guess where rents are going to stay? They're going to stay high. And to what Kyle just said, we're not needing the Class A $2,000, $2,500 rental market. We need the $1,000 to $1,500 rental market, and that's just more of your existing assets, and that's what people need. So yeah.
And you're still doing well. People think they say, oh, let's say rent goes up 4% and expenses go up 4%. People say it's a wash. It's not a wash. Your expenses are only 50, roughly, whatever. If Phoenix is lower, but say it's on average 50% of your revenue. So your NOI is still going up. So just keep that in mind, that you're still improving the property from an overall NOI perspective, even if revenue and expenses go up exactly the same.
Yeah,
True.
that's true.
Very true.
That's true. Yeah, and there's a question actually here that I want to touch base on that kind of ties in with this about the reasons we invest in multifamily. And I think one of the things I try to add to this conversation as well is the economics of what's happening. I mean, there's been a 40% increase in the money supply that's either physically or digitally created in the last 2 years. And so, that is going to have a significant impact. If you look at inflation and you look at rents, rents typically lag a little bit, but over a long-term trend, they really keep pace. So to me, I just think there's no better way to preserve and grow wealth through cash flowing assets that pay you to hold them, that have such a strong inflation hedge, such as multifamily. So to me, that's why I love it. And you get to use debt to be able to buy it. So you don't even have to put all your own money down. The property goes up 20% or 25%. And a lot of times you've actually doubled your equity, which is crazy, right? Because of the leverage that exists in the property. Can some of you guys just share maybe some of the reasons that you are, because I look at this around this virtual room here and we're all in for multifamily. So what are some of those reasons maybe that I didn't touch on that you love multifamily as an investment class?
Taxes. I haven't paid taxes since 2016, federal income tax. And the other one I would say for me would be the whole idea which you brought up, to put in perspective. If you can increase your NOI $50,000, at a 5 cap, that's $1 million of value that you just added to the property. So I don't know where else you can do that, frankly. I don't.
Go ahead.
No, you go.
Reduce downside risk because of the value add piece, which is what Mark just said. If you know how to operate a business and you can operate it better than the person next door, your property is going to be worth more, your value is going to be worth more. But just by being a good, sound business owner and operator, you can really increase value, millions and millions of dollars. And so there's just, again, like Mark said, there's nowhere else that I know you can do that.
And I'll round it out with being the only international focus. You do not find multifamily on the scale you find multifamily. It doesn't even exist in Australia. Canada's a hybrid. Europe doesn't even have it. So to the fact that they're building, so much multifamily here, in the way, and that comes through the debt structures, the way it's been financed, the way that people approve it, the way in which we live and want to live close to urban centers, and the growth of 350 million people trying to live across the country. There's all these other demanding factors that is really pushing it to being the best in class. Look at how well it fared throughout COVID compared to hospitality, compared to retail, compared to hotels. Those markets will come back. But then when you take even a bigger viewpoint, if you compare it to other international Western countries, that doesn't even exist in those other countries. So the US is very unique in this type of product on a mass scale. And it goes everything from financing to construction to the way people invest.
Absolutely. Yeah, it really, it's like an unfair asset class. And that's one of the challenges is that people that have money or have the ability to get into these deals, they're going to dramatically benefit. And people that are on a fixed income or don't own assets are going to get destroyed over time because of inflation and because of other things. So I think that's really a good point. We've got time for maybe one more question, and then we're going to just announce the next event that will happen on April 6th. Which is going to be an exciting event as well. So regarding underwriting, I guess there's a question that comes up of what sort of tools would you recommend somebody kind of goes to, or methods to learn that? I know, Mark, you have a tool that does this. There are people that sell kind of underwriting tools. Is there any suggestions you have for someone who's trying to learn how to underwrite deals? How would you suggest they go about that?
We got some free content if they want to reach out for sure on that. And then we do it's a paid, but it's a 2.5-day workshop where you bring your computer and work through deals. And might just prompt it up. It's just something we do because I think it is so important. We only do it once a year. And we usually limit the attendees that can go to like 150 this time. So it's not very, very big event. But there's a lot of stuff online you can go to. I know the commercial real estate groups have some kind of videos and things like that out there as well. So, I don't know what other guys are using, but if you don't understand it and you're trying to make an investment, even as a passive investor, I would say don't do it. Make sure you at least understand the fundamentals. You don't have to be the expert, inside and out, but you need to at least understand what you're looking at before you invest.
Yeah, Warren Buffett, he says, we don't invest in anything we don't understand. So, it's really important that whatever, if you invest in or you get starting to work on, it's really important that you understand how it works and how it can go well or how it won't go well. So, Kyle and Reed, any suggestions on tools?
Practice makes perfect. So if you really want to learn how to underwrite, just underwrite 100, 200, 300 deals, and you start to see consistencies in different things, and you start to ask different questions. And so that's the best way to do it. But yeah, underwriting can be very technical. It's a science and an art. And so we actually hire it out, and I hire an analyst who has been in the industry on the institutional side, and I get to learn from that person as well as they underwrite our deals. And you can do it for fairly cheap now. So why not pay someone a little bit to give you an advantage, especially in this market? You need every advantage that you can get. And so if you're just learning to underwrite and you're trying to get your first deal, your back's up against the wall. So really get an expert who knows what they're doing. But practice does make perfect.
Awesome. Well, guys, I'm going to go ahead and just go over the next event real quick, and then we're going to wrap here in a minute. But I wanted to share my screen. So just wanted to show you one of the, this is the next event coming up. Like I mentioned, we do inflation events. A lot of you have attended these events. This one's going to be great. It is April 6th. I put the link in the chat there, so you should be able to see it at 4 p.m. Pacific. We have Brian London, who's the head of the New Orleans Investment Conference, Jason Hartman, and Russell Gray. This is going to be a great conversation about what do we actually do in an inflationary environment. So I think it's very important to look at that. And go ahead and stop sharing here. And then let me make sure I get back. Okay, awesome. Well, gentlemen, I just want to say for each of you, this was a very well-selected panel. I have tremendous respect for each of your businesses. I recommend that everybody who's watching this, either live or on a replay, reaches out to you for your current deals because you are operators that I admire. So admire all of you. And I'm partners with Mark on a couple deals as well. And then we also do deals as well. So if anybody's interested in reaching out, we are all available to reach out. And it's a great way to learn. If you're not quite sure how to do it, to get involved, just start the conversation, take action, really get moving. But gentlemen, thank you so much for joining today. Thank you for everybody that has joined on. This replay will be sent out to you via email. And if you do have any questions or suggestions as far as who we should have on the next panel, we have April is planned for inflation. We'll have another multifamily one in May. If you have suggestions, please let me know. But anyway, thank you again so much. The best investment you can make is in your own education, and you did that tonight. So thank you, everyone.
Thanks
for having us.
Thanks, guys.
See you, Reed. See you, Kyle.
See you guys. Good to see you again.
See you.